you go to the investment banking conferences, to me, it's all life sciences. You know, the days of going and seeing. I mean, Chris, you presented at the not William Loki City.
Yeah, CIT.
CIT this year, and there weren't very many healthcare science companies, healthcare service companies. Oh, that's my preference.
Yeah, it's hard for me to give an answer because we ourselves, as a firm, only invest in essentially biotech devices and selectively molecular diagnostics. So we don't invest in healthcare IT and services. Those have slowed down, and those tend to be smaller type of investments. Our range, sort of in the biotech world, is like an average of 20 to 25 million per company for the financing. So we're what you would call more of a clinical stage investor. Clearly, biotech has slowed down quite a bit, not just because there's less money available, but all the funds, including ourselves, everybody's investing a little slower. It's almost like when it's foggy, you slow down to see what's going on. So part of it is not because there's still a lot of money available, I'll tell you that, but it's being distributed much more cautiously, selectively, and slowly. Clearly, one area that's sort of on a high right now is sort of the .com of today is the clean tech and green tech. That's where a lot of the big investments are happening. So, but I do think there'll be less money available just because some of the funds will be gone. It's much harder to raise funds. We know funds, top tier funds, they're still trying to raise to hit their goal and can't. But I don't think it's a disaster. I think there's money available, but I think the bar is much higher. For us, philosophically, as a firm, we still have to love the science and believe in the assets. It's not just a matter of buying something because it's discounted. It has to be at the quality level where we can have a significant inflection point. And because of the public companies being encumbered with so much more complexity in managing them, et cetera, there's really a balance. So I don't see necessarily, for the VCs in life sciences, I don't see the stampede effect going towards public companies to the extent where it significantly affects their ability to invest on the private side. You have to be very selective because usually in a lot of the public companies there is a reason they're part of it is the market conditions, but part of it is the assets haven't done well. Everybody's tired. So you don't always find a lot of diamonds there. Occasionally you'll find a diamond in the rough. Something can be redirected and resurrected and repositioned for value inflection. But we're still very selective with those. We're not just buying them because, we're not just looking at them because they're, and we looked at a number and we haven't invested in very many. We just look at a lot more. But the bar is still high for the science, for the assets, for the management team. And a lot of times those pieces are not quite right, and it's much harder to change those things in a public company.
If I could get 0.1% of that 25 billion, that would be great. We're looking to do a 10 to 12 million raise if we could. I'm listening very carefully to private equity VCs. There's money there, and it's exactly as Christina said. The investments have slowed down, and so what I hear is it's the old story of if you're a clinical stage company, then everybody wants more data. And when you show them clinical data, they say, looks good, but if you only had more data. So I'm seeing that there's still interest, there's money still available, but it gets back to my earlier comment. One has to have those fundamentals in place of management, good rationale in the pipeline, and sort of a balanced risk across the pipeline for investors to pull the trigger. So it's there. It'll just take a little more time to convince.
I just wanted to make one comment. We've actually been out over the last year or so looking at raising money for recapitalization. We're always looking at our options, and a year ago, probably last June or so, we were told by people on the street, our advice to you is just go out and borrow as much money as you can, because not only is it you can get debt covenant light, there's no covenants at all. So just go borrow as much as you can. And we fortunately were disciplined enough not to do that. What's changed since then, because we still constantly look at that, we have a great business model, we've got great metrics, we've got good cash flow. And what we're finding right now is people are very interested. We've got a very predictable model. We have growth. the industry we're in does have a built-in kind of growth model. The disease state that I'm in, kind of along Carl's history, you know, diabetes and hypertension are the two big drivers in renal disease. And, you know, those are off the charts. And so the business grows, and it's a very predictable model, and we've got good numbers. As you try to look and get deals done, people are very interested in investing, but there's no debt capacity out there. So people, and Christina can talk to this, they either got to put up more equity and maybe go back later and recap the deal and bring in debt. It's the debt piece that's frozen. So goes that, I think, so goes the ability for this $25 billion to get out there, I think. And until there's some relief there, I think there is a lot of money on the sidelines, but the debt markets have to get straightened out, I think, before you're going to see a lot of movement here.
And the networking piece is critical because sometimes if you're in that sort of inner circle of people that have started companies before, they know each other, they're willing to take more risk. But otherwise, having an asset that's, let's say, 3 years from the clinics, you're still pretty much in discovery, deep in discovery, with an unvalidated target in one indication and be able to generate one compound, that's going to be a tough sell compared to 2 or 3 years ago, as opposed to a more balanced risk where you have a few things along the continuum of the pipeline, or at least you have a validated target or something that's been sort of independently produced. But that kind of open-ended science would be much tougher to support with significant financing from venture. Competence obviously has to be there. That's the starting point, because we need to understand. I mean, you know, and obviously you see a spectrum, you see brilliance. You also see, you know, much more unusually, but you see the time when you have patients with the CEO says, well, I can't really explain the science, or, you know, I don't really understand how it works, but we can send you guys the papers. That doesn't happen a lot. So it starts with confidence, and then the integrity and transparency, and making sure that you're hearing the true story. It's not being, everybody's a little bit self-promotional because they love their science, but it's not being inappropriately promotional or somehow kind of misguiding. The other piece of the management is, and I think somebody mentioned having the right management team, is the dynamic within the management team. Is this a group that's working well together, or is this a group that's clearly dynamic? Is they're all terrified and only the CEO speaks and everybody else is just very quiet and they cannot have a voice that's not successful? They cannot run successfully in a small biotech company. And then, do they have the key people in the areas that are going to drive value inflection? So if it's a discovery play, do they have a strong CSO? And what often happens at the stage we invest in, do they have the person that's sort of industry trained as opposed to still the academic scientific founder who was a great scientific founder but cannot really drive the discovery and development in a biotech? And we see this a lot, where clearly it's time to transition that person to just be on the SAB, but to need somebody who's a savvy, professional with the right skill sets. Or if it's a clinical inflection point, do they have a CMO or head of clinical that's appropriate for the role, or are they not staffed appropriately in those key areas? So I think that those are sort of they don't necessarily have to have the full staffing of senior management as you would see at a big company, because in today's world, a lot can be outsourced. But do you have the experience level in the company to know how to oversee the outsourcing? As we all know, we need experienced people to understand what's being outsourced and how it's being done. So I think those are